In the Dominican Republic today, it is much more advantageous to buy an apartment in a complex that is under construction than to purchase a finished property. Unlike in Toronto, pre-construction apartments are 15% cheaper than completed. Plus, when you buy a new development, you don't pay land transfer tax when taking ownership, and you don't have to pay annual property taxes for 15 years. Adding up the advantages, a new build apartment is often 20 to 25% cheaper than a similar one on the secondary market. In addition, there are very few resales of luxury apartments in already completed high-end complexes. And complexes built before the year 2000 are very different from what is being constructed here today. In the past few years, major American and Spanish construction companies have entered the East Dominican market, and what is being built here today is of a completely different construction quality compared to what was built before. Most of today's complexes are super luxury condominiums with meticulously planned infrastructure down to the smallest detail. You bought an apartment in the Dominican Republic to vacation in and rent out short-term through the complex's management when you're not there. As is often the case, there's no extra money. Where can you get it? In the Dominican Republic, unlike Canada, you can't just pay 10 or 20% down and get a mortgage for the rest after construction. The standard payment structure when buying a new build is a deposit of 25% of the price upon signing the contract, and another 45% must be paid during the construction period. These payments are usually tied to the stages of construction. Thus, over the course of 2 to 2.5 years of construction, you need to pay about 70% of the property's value. And if you don't have your own funds, the most popular type of financing is a line of credit taken out against property you already own. Many people obtain such a line of credit secured by their own home and use it to make payments for the property they purchased in the Dominican Republic. So the first option is a line of credit secured by property you already own. This option is good because you only pay interest on the money you actually withdraw from the line of credit opened for you by the bank. You need to make payments for the new purchase over the course of 2 to 2.5 years in small installments, and this allows you to save significantly on bank interest. The second option is refinancing property you already own. For example, you once bought a townhouse for $700,000 with a $500,000 mortgage. Time has passed. Today its price is $1,200,000 and the mortgage is less than $400,000. You refinance the townhouse, increase the mortgage to $700,000, and receive a check from the bank for $300,000. That is the amount needed to buy an apartment in the Dominican Republic. In this case, you start paying interest on the $300,000 as soon as you receive the money. And you are not required to pay the full amount for the new purchase all at once, so you end up paying interest on money that you aren't using yet, and that is just sitting in your bank account. But there is another way to do things. There's a good option that allows you to save on interest. In the Dominican Republic, paying the full price up front for a new apartment instead of in installments gives you at least a 5% discount, sometimes up to 10%. So overall, there's practically no difference between refinancing and a line of credit. And many people choose refinancing, especially if their previous contract with the bank is ending and there is no penalty for early repayment of the mortgage. I think that in the coming years this option will become the most popular, since rates are expected to drop significantly soon, and those who were forced to get a mortgage or refinance an old one at high rates will want to refinance again at a lower rate, and at the same time receive a substantial amount of money from the bank, which is completely tax-free. Another popular option is co-ownership. Suppose your family vacations in the Dominican Republic for 2 months a year. You can buy an apartment in co-ownership with 2 or 3 other families, and each family will have 2 months of vacation during the year. The details of such an agreement are set out in a contract, and since this option has become quite popular recently, you can arrange such a contract right in our office. That is, for 6 months of the year, the apartment will be used by the owners, and for the other 6 months it will be rented out short-term, bringing the owners a decent additional income. The numbers look roughly like this. The purchase price is $300,000, and each family contributes $100,000, receiving 2 months of vacation in the apartment, plus about $10,000 a year in passive income. If in a given year a family does not use the apartment, then the rental income for that period is not divided into 3 parts, but goes to those who have given up their time for rent. And in this case, that's another $10,000 a year. So you get about 20% return on your investment just from the rental income. Plus, there's the appreciation of the property. And finally, the last point is financing the deal through a bank. 3 months before the completion of construction, you can apply for a loan at one of the Dominican banks or at an international bank such as ScotiaBank, which has a strong presence both in Canada and in the Dominican Republic, and receive financing for 70% of the market value of the apartment at the time construction is completed, which is usually 80 to 85% of the purchase price. Moreover, obtaining such a loan is actually quite simple. After receiving the financing, you repay the money you took from your line of credit to pay the deposit during construction. By using this scheme, you end up with roughly the same type of financing that most of our clients are used to in Canada. The loan interest rate is higher than in Canada and currently ranges from 7 to 9%, depending on the bank. But interest rates, just like in Canada, have already started to decrease and will most likely reach around 4% in the next couple of years. This mortgage doesn't show on your Canadian credit report or affect your ability to get future mortgages. The apartment you bought on credit gives you monthly income from short-term rentals, appreciates in value, and you can sometimes use it yourself. Our company provides a full range of services for property selection, financing, and transaction processing. Don't miss the chance to buy an apartment in the Dominican Republic today while prices are still affordable. Today, real estate in the eastern part of the Dominican Republic is steadily increasing in value by 6 to 7% per year, and in some of the most sought-after areas, prices have risen by 12 to 15% in just 1 year. This was Maxim Baginski. See you again on the channel.